Last week we had both the best and the worst day in the stock market in 2024, and in fact when we do zoom out to look at semiconductors over the last month, they have had a very poor performance. Nvidia down 18%, AMD down 26%, Qualcomm down 18%, and our focus in today's episode is going to be Broadcom. Now this is one that is down 16%, continuing the trend of semiconductors as a whole, but what we do notice, Wall Street does give it a strong buy, and today we want to understand, should we be buying the dip on this very high quality company? First things first, let's look at some of the underlying metrics. Dividend safety score 67, so we have safety indicated, and we can see a very nice double-digit growth to their dividend in December 2023. Now, what does a dividend safety score of 67 safe mean? Well, first thing to note, it was reaffirmed just a few months ago, but ultimately that a dividend cut for Broadcom is unlikely. Now, typically on the channel, we like to look at some key recessionary metrics, and we can point out that Broadcom had negative 13% sales, which was pretty much in line with the S&P sitting at that average level. Now, the first thing we love about this company are those double-digit increases to the dividend on a very consistent basis over the last year, as we pointed out, over the last 5 years at 19%, and over the last 10 years, high single-digit at that 8% point. And in fact, they have been increasing those dividends for the last 5 years, as in fact we can see they did cut it in 2017. We then move on to essentially dividend yield theory. Now what this states, a company is undervalued when the current yield sits above the 5-year average. So we have a first overvaluation signal, as well as the forward P 27.2 above the 5-year of 16.1, and in fact it is marginally higher than information technology at 25.1. So bear in mind, we don't look at any of these models in isolation. We will conclude towards the end, and sometimes companies are worth paying a premium for than essentially the sector as a whole, because they are high quality, something that we will point out with this company. Free cash flow payout below 50% for semiconductors, and in fact from 2018 it has been around that 50% level, 35 over the next 12 months, so don't be surprised if this December we do see a very nice double-digit increase. Then we get to free cash flow per share. Now, what do we constantly say on this channel? Consistent increases over longer term. This is pretty much the model example of what we are talking about. Consistent increases over long term and expected to continue the upward trend over the next 12 months. Then we move on to the sales growth, where we want to see 3 to 7%. Very strong growth for Broadcom, which you could argue is in a cyclical industry. 8% in 2023, 22% on a trailing 12-month basis. And when we do zoom out, as we can see here, massive growth over the last 10 years. We're talking about around 9 times from 2014 to 2023. Now, we do have to point out that they would have diluted your position over the longer term. What we do want to see ideally are companies that do share buybacks, returning excess cash to investor pockets. Not something we see from Broadcom, but when we do look at their performance over the longer term, you will be in agreement that you probably wouldn't care given the massive growth it's had. ROIC then, return on invested capital, typically 10% or more, 12 if you want to be industry specific. Give us that faith that management are able to effectively allocate their capital. Now, it is a little bit inconsistent, but nice to note, more often than not, it is around the 10% plus level, 26% in 2023. We then move on to the margins, and one of the criteria that we talk about when we say high quality, increasing not just their revenue, but also operating efficiency, so their margins, something we do note, maybe not on a consistent level, but over the longer term, going from 21% to 46% in 2023. Free cash flow margin as well. This is a true example of what we mean when we say free cash flow machine. Just over the last 40 years, we're talking about 50% year on year. We then move on to the net debt to EBITDA. Now, this is important because it correlates to both dividend safety and balance sheet strength. EBITDA referring to the earnings before interest, tax, depreciation, amortization. And the numbers you see below are the number of years it would take the company to pay off all of their debt net of cash on hand. Below 1.5 is what we want to see. Now, granted, 1.1 is what we get in 2023, but we have to point out over the next 12 months, it is anticipated to increase to around 1.85. But overall, it isn't the biggest jump above 1.5. The free cash flow payout does look healthy, so we can understand balance sheet does look fairly secure, and the dividend also looks safe. Now, we also want to run back to the company, just look at the historical performance. As we said, down 16%, pretty much in line with the industry for semiconductors as a whole. Year to date, nonetheless, very strong, up 33%. That has outperformed the S&P year to date. Over the last year, phenomenal performance, up 74%. And over the last 10 years, as we mentioned, incredible, up 1,882%. And bear in mind, that doesn't include reinvesting those dividends. Now, what is their performance? Well, at the moment, it is trading at the mid to upper end of the 52-week range. It does have what you could argue as a costly forward P of 31.2, and in terms of the yield right now, 1.42%, but it does increase it at a rapid rate, and nice to see that strong buy rating from Wall Street, the buy from Seeking Alpha with the hold from Quant. Now, we also want to take a look at how they perform, not just on the top line revenue, as we already mentioned, but also the bottom line net income. And just looking at it from a graphical perspective, that is some very strong growth over the period. As we said, 9 times from 4.3 billion in 2014 to 36 billion in 2023. Now, ultimately, how does their bottom line story tell us? At their net income level, 263 million. That is a massive increase to 14.1 billion in 2023. But when we look at it from a graphical perspective, we do see a little bit of inconsistency on a year-on-year basis. In fact, a net loss in 2016, massive growth in 2018 before coming down. And in fact, it hit that level again. You are talking about 4 years later. So bear in mind, there is inconsistency on the bottom line, not something we really want to see, especially from a company that has a very strong growth to their top line and incredibly consistent. Now, the next thing we want to point out is the health of this company, their total cash versus their total debt. 1.6 billion of cash in 2014, around 10 billion in their latest report. So over the longer term, it does follow their revenue trend pretty much. They have been holding on to a lot of cash over the period. Now, as we said, that number doesn't really tell us anything in isolation. That is why we compare it to their total debt numerically and directionally, and it has increased massively from 5.5 billion in 2014 to around 74 billion in their latest quarterly report. As we said, there will be that jump to the net debt to EBITDA, and there's a little bit of a worry, something that I would consider when looking to execute on this company. 39 billion to 74 billion, very large jump, and like their other metrics, their total debt has been increasing. Just something to consider, and maybe something we can factor in to the margin of safety. We then want to take a look at their earnings, historical performance, and future projections. And what we can see, a lot of consistency over the last 4 quarters. They have beaten management estimates and analyst targets. That is a 100% track record. And moving forwards over the next 4 quarters, they are anticipating double-digit growth to the EPS year on year. Now, if they hit the October 2025 estimate, that forward P will come down to around 24.5, something that maybe you could argue is a lot more reasonable. Now, just running through how they performed in that earnings period as well from the more recent one. Well, no surprises, we did talk about how they did recently have a 10-for-1 stock split, but as we said, they did beat earnings, looking very strongly as well. And when we look at that specific number, we can see 1096 versus the 1084 expected, as well as a very nice beat on the revenue, 12.49 versus the 12.03. Now, we also like to, within our own analysis, do both an insider and institutional movement analysis. We do know 2% in terms of insider ownership, 105 million worth of sales over the last year. We do also notice some buys around 10 million, but fairly small in comparison. In terms of the more recent quarter as well, we do see here 13 million. And when we look at who these insiders are for that full transparency, we in fact see that the CEO on the 11th of July, so just last month, did sell around 7,500 shares for $1,706. Remember, 10-for-1 split, so that would translate now to around $176. And that netted him around $12.8 million. Remember though, whilst we do show it for transparency, we're really looking for insider buying, which is a bullish signal, because management buy, they believe these shares will go up. Insider selling, not necessarily bearish news, as insiders sell for many reasons, personal and financial. We then look at the institutional ownership at around 76%, 2.4 billion worth of sales over the last year. We see nearly double the amount of buys over the same period of 4.5 billion, and we also notice a marginal more increase in quarter 2 in terms of buys and sales, and something we do see for quite a significant number of quarters. So as we do note here, institutions do love this company. They are buying a significant amount more. As always though, do your own due diligence, never copy insiders or institutions or any investor. In fact, have your own investment thesis. Now we also want to point out we have just released our latest free weekly article where we run through 3 undervalued dividend kings and also talk about the Japanese carry trade that happened last week. As always, you can grab a copy of each one of these to take a look at. It is instant access, and we have also released for the month of August 35 undervalued stocks, and we also talk about which one sits within our own portfolio. The next thing we're looking at are some gradings and some underlying metrics. The first one is AVGO's valuation at an F. No surprises, because ultimately when we look at their PE, 31.2 versus the sector median of 23. Right now, if you are executing on this stock, you are paying a 37% premium, but that is pretty much the story to be told on whatever valuation metric you use. AVGO does trade significantly higher than the sector median as a whole. Now remember, we do say sometimes it can be justified, and when we take a look at their growth where they get a B+, for example, their revenue looking very strong, 22% year-on-year growth versus the sector of 3.4. Forward looking as well, 22%. Sector, whilst higher, still much lower than AVGO at 6.93. And one of the things we draw your attention to here is the EPS, 18% anticipated growth over the next 3 to 5 years. The sector as a whole, 14.5. So again, whether or not you believe the massive jump in terms of the premium you're paying is worth it, that is something we do cover when we come to the valuation shortly. We then take a look at the profitability grade where they get an A+. Margins looking absolutely insane, 74% with the sector at 50. Bottom line, 24% with the sector at 3.6. And also when we look at their cash from operations, they are bringing in 19 billion when essentially the sector is bringing in 99 million. Now, quick wrap up for this part of the analysis. That strong buy, as we said, from Wall Street, the buy from Seeking Alpha with the hold from Quant, an F on valuation, B+ on growth with the A+ on profitability. Now, also part of our analysis, we like to look at how they formed against others in the semiconductor sector. We have Taiwan Semiconductor, AMD, Qualcomm, Texas Instruments, and a few others. And over the last year, Broadcom very strong, one of the best performing, up 77%. Remember, including reinvesting dividends. Taiwan Semiconductor just pipes it to the top place at 81%. Now, over the last 5 years, when we take a look, actually, Broadcom takes the first place at 528%. Over the last 10 years as well, we can see they do come in second, looking very strong, with AMD coming in at number 1. Now, just remember though, past performance is not an indicator of the future. Don't expect these same returns. It could be, in fact, a lot better, but it could also be significantly worse. Just for transparency, as we like to keep things very consistent on this channel, we want to show you, and there probably are no surprises there, Broadcom has consistently outperformed the S&P over the last year, over the last 5 years, as well as over the last 10 years by a very significant margin. It is also important though, do bear in mind, like we just mentioned, because they've done it over the last 10, they may not do it over the next 5, 10, 15, depending on what your investment horizon is. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value of $165, how we got to that today is we ran it through the DCF model where we have the free cash flow year on year, we have the average growth rate at 48%, and ultimately we have gone for a low, medium and high growth rate at 10, 15 and 20%. Now with the 15% rate and the discount rate, we get the present value of future free cash flows and terminal value. We add together with the cash, subtract total debt, get the equity value, divide by shares outstanding, and we have that undervaluation signal. So if you believe that Broadcom over the next 10 years and beyond will have free cash flow growth of around 15%, right now we see around 11% upside. There are people that will say that is way too conservative, use 10%, and for that, just for transparency, at that 10% level, we can see the intrinsic value comes around $112, indicating around 25% downside to the current price. Conversely, there'll be investors who'll say, no, you need to go a lot higher, and at the 20% level, $240, indicating 61% upside. Remember, you can grab a copy of this model by clicking on the pinned comment below and running through your own numbers, in fact, whether it's for Broadcom or any other company. So let's take the 15% level, the medium rate, through to the next slide, and what we have here is that intrinsic value. Now look, Wall Street don't agree. They see a lot more upside over the next year. In fact, at $196, they see 32% to be specific. And what we like to do is also run a margin of safety. Now at 10%, remember we execute on this if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Which pretty much takes us to the current price at $149. Now, a lot of people will argue that Broadcom meets all of the criteria, and in fact, sometimes you would be willing to pay a premium for this high-quality company, but as we can see, it sits at the 10% level right now. For those looking for a little bit more, well, at 15%, you'd have to wait for around $140, $41, and at the 20% level, around $132. Now, personally, for me, this isn't one that I will be adding at this 10% level. I would ideally like to wait for around a 20%, around the $132 mark, and that is where I will dollar cost average in to what I believe a high quality company. But as always, bear in mind this is also a cyclical industry. So in conclusion, a 10% MOS at this price with 32% expected from Wall Street over the next year, and this is all on the basis of a median rate of 15%. Ultimately, if you do use a lower or higher rate, that will affect these numbers that we have in the model. As always, let us know your thoughts in the comments below. If you are looking to buy, maybe you're looking to add it on the watch list, or maybe in fact you believe we're at the top of the AI bubble and it will pop, and maybe you are looking to offload. If you enjoyed the episode, smash that like button, hit that subscribe and bell button so you are continually notified. Don't forget as well to sign up to the free weekly newsletter below, and also if you want to come and join us on the Patreon where we discuss our weekly buys and sells. As always, have a great day and we'll see you all on the next one.